In the beginning, there was barter. It was a system deeply rooted in simplicity and necessity, wherein people traded what they had for what they needed. However, this system came with limitations, the primary one being the coincidence of wants. The value of goods was subjective, often leading to conflicts, and perishable goods could lead to waste. To overcome these difficulties, humans began to use commodity money, such as salt, tea, cattle, precious metals. For example, salt was a precious resource due to its ability to preserve food, leading to its common acceptance as a medium of exchange. Statistically, during the Roman Empire, a soldier could have been paid an equivalent of 20 kilograms of salt per month for their service, showcasing just how valuable this commodity was. Yet as societies evolved, the need for a more convenient method of exchange arose. This led to the invention of paper money and coins, marking a significant step in the evolution of currency. They were uniform in their value, making trade more efficient. However, this convenience brought issues such as counterfeiting and inflation, where the value of money could decrease due to an increase in the supply of money. For instance, during the U.S. Civil War, the Confederate States saw inflation rates rise to nearly 10,000%. To tackle these challenges, digital money was introduced, opening a whole new era in financial transactions. With the advent of key technologies like cryptography and blockchain, Bitcoin became the first cryptocurrency in 2009. It holds the largest market cap among cryptocurrencies, with its price peaking at nearly $65,000 in April 2021. The technology behind cryptocurrencies, blockchain, is a decentralized ledger system that records every transaction across numerous computers, making it virtually impossible to alter or counterfeit. This tool played a vital role in overcoming issues like counterfeiting that plagued traditional forms of money. However, much like its predecessors, cryptocurrencies have their own set of issues. The anonymity provided by cryptocurrencies has often been abused, leading to its use in illegal activities. According to a report by Chainalysis, around $10 billion worth of Bitcoin has been associated with illicit activities. In the evolution of money, from barter system to cryptocurrencies, we've seen constant change and adaptation to meet the needs of societies. As the landscape continues to evolve, it's clear that our understanding and use of what we consider money will continue to change. In the closing years of the 20th century, a meteoric rise of digital money was observed. The advent of credit cards, the burgeoning of online banking, the proliferation of mobile wallets. This wasn't merely the evolution of currency, it was a seismic revolution in the financial world. An estimated 3.5 billion people across the globe were caught in this transformative wave of convenience and speed. Hard-earned salaries, lifetime savings were no longer confined to physical vaults or hidden under mattresses. Instead, they were encapsulated in plastic cards, visually no different from an ID card, or housed in virtual safes, accessible only via a screen and a few keystrokes. This paradigm shift wasn't merely about convenience. It hailed a new age of financial independence, redefining the concept of wealth and transactions. People could now conduct trade and business, buy or sell goods, even order a cup of coffee without the need of a physical currency. The reach was limitless: distance, time zones, borders. None could fetter this new financial freedom. It was as if someone had endowed the very concept of money with wings. But this newfound emancipation was not without its share of trials. With an estimated $4.2 trillion in digital transactions in 2020, myriad questions, doubts, and fears started pouring in. The age-old adage of money being safe only under lock and key seemed to lose its relevance, replaced by alphanumeric passwords. But was this new key as safe? Then there was the colossal concern: privacy. In an increasingly digital world, our identities seemed unprotected. Each transaction left a trace, a digital footprint, that led straight back to us. The mere notion of a stranger having access to such intimate information was petrifying. It was as if our lives had turned into an open book, waiting to be read anyone who knew the right codes. The issue of control was not far behind. The once physically perceived concept of money flow transformed into a virtually regulated phenomenon. The power to govern it, once vested in a few trusted institutions, was now entrusted to faceless corporations and technologies like blockchain. The idea of our hard-earned money being controlled by entities we couldn't see or touch was unnerving. When cryptocurrencies like Bitcoin and Ethereum surfaced, they seemed an answer to some of these questions. Using blockchain technology, they aimed to offer solutions to privacy and control issues. However, they also brought their own set of problems, including the risk of abuse and volatility. The dawn of the digital era was soon eclipsed by the concerns it brought with it. A Pandora's box had been opened, unleashing questions about security, privacy, and control, all while we wondered who could guarantee the safety of our money? Who had access to our personal information? Who controlled the flow of our hard-earned cash? Welcome to the enigma of cryptocurrency, a realm that sprang into existence from the mind of an elusive entity christened Satoshi Nakamoto. This figure, known only by this pseudonym, proposed a new digital currency system in a mere 9-page white paper in 2008. This cryptic mind, unbeknownst to the world, was about to spark a financial revolution. This radical idea was elementary yet groundbreaking. It envisioned a world unshackled by government regulations and financial institutions, a world where economic power was not hoarded by a handful of entities. The proposed system was all about decentralization, about establishing an economic environment that offered sovereignty, freedom, and an unbreachable right to one's assets. This wasn't just about decentralization. Nakamoto's groundbreaking idea was also about security. At a time when estimates indicate that cybercrime will cost the world $10.5 trillion annually by 2025, Nakamoto suggested a system robust against data breaches and cyber attacks. The proposal was to create a digital fortress that shielded users' assets from hackers and online predators using blockchain technology, a type of distributed ledger technology, DLT, which is a chain of blocks made up of digital pieces of information. Further, it pledged privacy. In an era where every click and transaction are scrutinized, this revolutionary idea promised a sanctuary of privacy. It imagined a world where financial transactions were executed with assured anonymity, and the user's financial history stayed confidential, all made possible by cryptographic technology. In 2008, Nakamoto's vision morphed into a tangible reality named Bitcoin, the genesis of cryptocurrency. With a current market cap of over $600 billion, this innovation was not just a pioneer, but an emblem of the potential of digital currency. It lit the path for over 4,000 other cryptocurrencies, including Ethereum, Ripple, and Litecoin, each employing varying technologies and mechanisms. Bitcoin, being the forefather of all cryptocurrencies, marked a turning point in the history of finance. It's a world that has seen its fair share of use and abuse, from serving as a decentralized currency to its darker side of facilitating illicit transactions due to its anonymity. Despite this, it stands tall as the testament of a revolution, and finance, as we knew it, would never be the same again. Conceived around a technology termed as blockchain, Bitcoin became the harbinger of a secure, decentralized financial system. This technology operated much like a digital ledger, a locus where every transaction was meticulously recorded and stored. From the very first transaction, the purchase of 2 pizzas for 10,000 bitcoins in 2010, to the 21 million bitcoins that are expected to be mined by 2140, every transaction is visible to all, a revolutionary concept in the world of finance. This blockchain technology is not just accessible to all, but it's unique in that despite its openness, no one person or group has the authority to make alterations. It gave birth to an unparalleled level of transparency, allowing any individual to verify each and every transaction that has ever taken place. The real crux of its significance lies in its immunity to alterations. The absence of central authorities or third-party intervention meant the ledger was as decentralized as the currency itself, very much akin to other major cryptocurrencies like Ethereum and Ripple. Security measures were amped up by the meticulous utilization of cryptographic algorithms, embodying another level of complexity to the system. These algorithms made transactions not only secure but also ascertained their integrity. The tools used for mining Bitcoin, such as application-specific integrated circuit, ASIC devices, and graphic processing units, GPUs, further enhance the security of the system. The appeal of Bitcoin lies not only in its potential as a currency, but also as a tool for financial privacy and its uses in darknet markets and money laundering, showcasing its potential for both use and abuse. This amalgamation of transparency, security, and decentralization transformed Bitcoin into much more than a digital currency. It embodied a paradigm shift in conceptualizing and transacting with money. Consequently, the blend of transparency and security offered by cryptographic algorithms has rendered Bitcoin an appealing prospect, setting the foundation for the future of finance. Since the inception of Bitcoin in 2009, over 6,700 diverse cryptocurrencies have been introduced, each designed with distinct features and unique applications. This digital financial era pioneered by Bitcoin has since evolved to include an array of technologies and innovations. The underlying technology, blockchain, has been leveraged and modified, laying the groundwork for revolutionary advancements. Ethereum, introduced in 2015, brought an innovative concept to the table: smart contracts. These programmable transactions, which operate within Ethereum's blockchain, have the capacity to self-execute when conditions are fulfilled. This sparked a new era of automation and decentralization, accounting for nearly 80% of initial coin offerings and decentralized applications as of 2020. Next in line is Ripple, launched in 2012 with a targeted objective of transforming international money transfers. Ripple's technology, XRP Ledger, aimed to expedite these transactions, making them cheaper and more efficient. Today, Ripple settles international transactions in just 3-5 seconds, as opposed to traditional banking systems which can take 3-5 days. This has significantly contributed to a shift in the global financial ecosystem, with Ripple now having over 300 financial institution partnerships across the globe. Not to be overlooked is Litecoin, another prominent contender in the cryptocurrency space. Launched in 2011, it differentiated itself by offering faster transaction processing times, a necessity in the world of digital transactions. Where Bitcoin's average transaction confirmation time is around 10 minutes, Litecoin's is approximately 2.5 minutes, thus providing a more efficient alternative for users. However, alongside their many uses, cryptocurrencies have also been subject to abuse. With anonymity being a key feature, they have often been used in illegal activities and illicit trade. This underscores the importance of regulatory guidelines and user vigilance in the rapidly evolving digital financial landscape. In conclusion, the diverse world of cryptocurrencies, powered by cutting-edge technologies such as blockchain, smart contracts, and fast transaction processing, continues to revolutionize financial systems worldwide. Cryptocurrencies, a revolutionary technological advent, have faced their share of controversy. Born from a desire for a decentralized financial system, they've carved out a significant niche with around 5,392 cryptocurrencies trading worldwide. Yet, they have not been without their pitfalls, sparking heated debates and contentions. One major concern revolves around their use for unlawful activities, given their decentralized nature and the anonymity they offer. For instance, digital currencies like Bitcoin, utilizing blockchain technology, have become a preferred mode for illicit online transactions, including financing terrorist activities. According to a 2020 report from Chainalysis, approximately $10 billion worth of Bitcoin was moved on the dark web. Their extreme volatility is another point of contention. The unpredictable rise and fall of cryptocurrency values, such as the 2018 crash of Bitcoin, when it lost over 80% of its value, have resulted in catastrophic financial losses for many unsuspecting investors. This capricious nature, coupled with a lack of consistent values, makes investing in cryptocurrencies akin to a high-stakes gamble. Moreover, the environmental impact of cryptocurrencies, particularly Bitcoin, has drawn criticism. It is estimated that Bitcoin mining consumes around 121.36 terawatt-hours (TWh) a year, a rate comparable to countries like Argentina. This mining process requires significant computational power, often sourced from non-renewable resources, leading to increased greenhouse gas emissions. Tools like CoinMarketCap and CryptoCompare, which provide data on different cryptocurrencies, have also raised concerns about potential market manipulation. In essence, while cryptocurrencies like Bitcoin, Ethereum, and Ripple have revolutionized the financial landscape, they continue to invite controversy, and cryptocurrencies, despite occasional setbacks, continue to see an upward trajectory in their popularity. To put this in perspective, there are now over 5,000 different types of cryptocurrencies with a market cap exceeding $200 billion. The burgeoning popularity of these digital currencies is attributed to the distinctive liberties they proffer. They exist outside the realm of traditional banks and governments, granting users an exceptional degree of control. In fact, estimated user ownership of cryptocurrencies ranges between 2.9 million and 5.8 million. The groundbreaking technology behind them, blockchain, operates in a decentralized fashion, presenting an innovative way to conduct transactions that is transforming the financial world. Its distributed ledger technology ensures that every transaction is transparent, preventing fraud and double spending. Cryptocurrencies like Bitcoin, Ethereum, and Ripple have dismantled geographical barriers in global trade, paving the way for opportunities for exponential growth and expansion. For instance, Nigeria, South Africa, and Venezuela are among the countries with the highest cryptocurrency use in the world, as per a Statista survey. However, the anonymity and lack of regulation of cryptocurrencies have also led to their abuse, becoming a preferred means for money laundering, illegal trade, and cybercrime. Furthermore, they have created a surge in financial inclusion, offering greater access to financial services. As per Global Findex database, 1.7 billion adults remain unbanked, but two-thirds of them own a mobile phone that could help them access financial services, an opportunity cryptocurrencies can capitalize on. Finally, they have fueled technological innovation, birthing new tools like digital wallets, mining hardware, and crypto exchanges. Major cryptocurrencies like Bitcoin and Ethereum have even influenced the rise of ICOs, initial coin offerings, and DeFi, decentralized finance. Significant advancements in the fintech sector. Undeniably, cryptocurrencies have become a mainstay of the financial landscape, heralding the dawn of a new era. In conclusion, the transition from barter to blockchain has been a remarkable journey, illustrating our relentless pursuit of progress. As per Statista, as of 2020, there are over 5,000 different cryptocurrencies being traded, with Bitcoin leading the market at a capitalization of over $685 billion US. These digital currencies, despite their benefits and drawbacks, have marked a significant evolution in our financial systems. Blockchain technology, the backbone of cryptocurrencies, with its decentralized and transparent nature, pledges to enhance control, security, and privacy. The use of cryptocurrencies has skyrocketed, with notable brands such as Microsoft and AT&T accepting them as valid forms of payment. However, the potential for misuse is also real. High-profile cases of hacking and fraud, particularly the infamous Mt. Gox hack in 2014, cast a shadow over these digital currencies. The future of cryptocurrencies is marked by the rise of major players like Bitcoin, Ethereum. Their innovative technologies, such as Ethereum smart contracts and Ripple's real-time global payment system, are shaping the future of finance. While the path forward may still hold uncertainties, one thing remains clear. Spurred by these momentous developments and the continued integration of cryptocurrencies into mainstream commerce, cryptocurrencies are here to stay.